This metal is about to break the global economy because every solar panel and electric vehicle needs it, and we are running out right now. We see the symbols of our green future everywhere. Vast solar farms shimmering in the desert, sleek electric vehicles humming down our highways, the silent 5G towers connecting our world. But this entire technological revolution is built on a foundation that's about to crack. That foundation is silver. It possesses the highest electrical and thermal conductivity of any element, making it utterly irreplaceable for high-efficiency applications. The 47th element, Ag, is the hidden linchpin. And the comfortable warnings you've heard about shortages in 50 years are dangerously optimistic. The data indicates we are facing a structural deficit within this decade. This isn't speculation. It's the inevitable outcome of a predictable sequence of events known as the four-stage commodity crisis pattern, a pattern that has repeated throughout history with devastating accuracy. This pattern always unfolds in four distinct stages. Stage 1 is complacency. For decades, supply is plentiful and prices are low and stable. The resource is taken for granted. Stage 2 is the demand surge versus inelastic supply. A new game-changing technology emerges, causing demand to spike relentlessly.
But mining output can't respond overnight. New mines take a decade or more to bring online. Supply is rigid, inelastic. Stage 3 is deficit recognition. The market awakens to the fact that consumption is now consistently outstripping production. Visible inventories begin to drain, and the countdown begins. Stage 4 is panic. The realization of scarcity becomes widespread, triggering a frantic scramble for the remaining physical supply and a vertical price explosion. Make no mistake, we are deep inside Stage 3 right now. Projections for 2025 show industrial demand for silver hitting an unprecedented 1.2 billion ounces, while mine supply struggles to reach 1.05 billion. This marks the fifth consecutive year of a massive structural deficit, draining global stockpiles at an alarming rate toward a point of no return. If this sounds theoretical, look at history. The 1970s oil crisis wasn't just about geopolitics, it was a textbook Stage 4 event. For half a century, oil was in Stage 1, complacency, trading at a stable $3 a barrel. Then, American domestic production peaked in 1970, right as post-war suburban consumption exploded. The inelastic supply hit a structural wall against surging demand.
Stage 3, deficit recognition, began. When the OPEC embargo acted as a catalyst, the market tipped violently into Stage 4, panic. Suddenly, there were lines around the block at every gas station. No gas signs became a common sight, and the price of oil didn't just rise, it shot vertically from $3 to $35, triggering a global recession, crippling industries and redrawing the map of global power. The world learned a painful lesson about what happens when a critical energy resource runs dry. And the pattern repeated just 2 decades ago with a lesser-known metal, palladium. Its critical new use, catalytic converters, an invention mandated by governments in every new car to clean toxic exhaust fumes. For years, the price was stable, but as emissions regulations tightened globally, demand surged against a fixed supply, sourced primarily from just 2 countries, Russia and South Africa. The market entered Stage 3 and inventories vanished. By the early 2000s, panic set in among automakers who legally could not sell cars without it. The price of palladium launched from under $500 an ounce to over $3,000, catching entire industries completely off guard and forcing costly redesigns. Time and again, history provides the blueprint. The pattern confirmed that when a critical resource hits a structural wall, the price doesn't just rise, it explodes.
Now, we are watching this exact same fuse burn down on silver, but the explosion will be far larger because the fundamentals are worse. The market is being held in a state of artificial calm by what can only be described as a cheap illusion. If you look at a chart of silver's price, adjusted for the relentless decay of inflation, you'll see a shocking truth. Silver is cheaper today than it was at its peak in 1980. This flat line on a chart is the lullaby meant to keep investors asleep. But while the price stagnates, a fundamental driver of demand has gone parabolic. The global green energy transition is not just a policy talking point, it's a physical reality being built with silver. Solar farms are expanding at a breathtaking pace, a sea of photovoltaic panels stretching to the horizon, and every single one of them requires silver to function. This one industry alone now consumes over 200 million ounces of silver every single year, a voracious, non-negotiable demand that grows with every new installation. The illusion of a calm, cheap market is being shattered by an exponential demand curve. This collision of price and demand leads us directly into the geological trap. Most people assume that if demand for a commodity rises, miners simply dig more of it out of the ground. With silver, this assumption is dangerously false. Roughly 70% of all newly mined silver is not from silver mines at all. It is a byproduct, an afterthought, pulled from the earth during the mining of industrial metals like zinc and lead.
A lead miner cannot simply decide to produce more silver. To do so, he would have to flood the world with an unwanted tsunami of lead, crashing its price and jeopardizing his entire operation. He is handcuffed by geology and economics. This critical fact makes silver supply brutally inelastic. It cannot meaningfully respond to price signals. It cannot ramp up to meet the insatiable appetite of the solar and EV industries. The supply is fundamentally broken, constrained not by a lack of will, but by the very nature of its existence in the Earth's crust. This brings the deficit into sharp, terrifying focus. Visualize a massive industrial scale. On one side, we piled the immense weights of our future, the millions of electric vehicles rolling off assembly lines, the continent-spanning solar farms, the 5G towers connecting our digital world, and the intricate electronics inside every device you own. Each is a heavy, undeniable block of pure silver demand. On the other side of the scale, we place the mining supply, a trickle, constrained by the geological trap. The scale doesn't just tip, it slams down on the side of demand with catastrophic force. This isn't a theoretical exercise. This deficit is real, and it is draining the world's available inventory. For years, demand has outstripped what the mines can produce, and the gap has been filled by emptying the vaults. But those vaults are not bottomless. We are now scraping the bottom of the barrel, a structural shortfall that gets worse with every passing quarter. This physical reality is completely divorced from the price you see on your screen. The disconnect is happening in the paper markets, places like the COMEX, where the price is set. Imagine a paper contract, a promise for silver, burning away in your hand. As the ash flakes away, it doesn't reveal a stack of silver bars. It reveals a single solitary coin underneath. This is the reality of the paper market, a leveraged system of promises where the number of claims on an ounce of silver vastly outnumbers the ounces that actually exist. For decades, this system has successfully suppressed the price, creating the cheap illusion. But that illusion depends on a belief that the physical metal can be delivered if demanded. That belief is now breaking. We are witnessing the physical warehouses empty in real time, creating a vacuum that paper contracts can no longer hide.
Once that vacuum is acknowledged by the market, the final stage begins. Panic buying from industrial giants who simply cannot operate without the metal. Imagine the scene. A factory manager in Silicon Valley, his face pale under the fluorescent lights.
phone slick with sweat pressed to his ear. He's not negotiating, he's begging. His words are clipped, desperate. Any amount, we'll pay any price. But the answer on the other end is the same one he's heard all day. There is none. His multi-billion-dollar production line, a marvel of modern engineering, is silent, paralyzed, starved of its most critical component. This isn't an isolated incident. Across the globe, boardrooms at Apple, at Tesla, at Samsung are in emergency sessions. The conversation isn't about profit margins anymore. It's about survival. They are dispatching teams not to secure contracts, but to physically acquire whatever silver they can find, creating strategic stockpiles at any cost. This is corporate hoarding on a scale never seen before, and the market is screaming. The price chart, once a predictable series of peaks and valleys, is now a vertical line. $50 an ounce is shattered without a pause. $75 becomes a distant memory in a single trading session. Then, in a move that liquidates hedge funds and breaks algorithms, the price surges past $100. This isn't speculation. This is the raw, unadulterated fear of being left with nothing. In this chaos, the old comforting myth of substitution is trotted out one last time. The theory goes that if silver becomes too expensive, industry will simply pivot to a cheaper alternative like copper. But in a clean room, a scientist learns a brutal lesson. He carefully solders copper contacts into a next-generation solar panel. The test begins. The results are immediate and catastrophic. Efficiency doesn't just dip, it plummets. The panel overheats, its output a fraction of what is required, rendering it useless for any practical application. Because physics is not negotiable. Silver is not just a good conductor, it possesses the highest electrical and thermal conductivity of any element on the planet. It is a fundamental law of the universe. The electrons move more freely through silver than through anything else on the planet. This isn't a feature that can be engineered around. In high-performance electronics, in electric vehicles, in the very solar panels meant to power our future, this property is not a luxury. It is a necessity.
There is no replacement. We have searched, we have tried, and we have failed. The reality is that for the technological world we have built, silver is irreplaceable. This brings us to the great wealth transfer. Visualize two piles of assets. One is a stack of paper currency, dollars, euros, yen. As you watch, the edges begin to curl and smoke before igniting into a column of flame, turning to worthless ash. This is inflation. This is the debasement that erodes the value of your labor, your savings, your future. Now look at the other pile. It's not paper. It's cold, heavy, physical silver. Gleaming bars that glow with an intrinsic, undeniable value. As the paper burns, the silver doesn't just survive, it becomes more radiant. Wealth is never truly destroyed in a crisis. It is transferred. It moves from those holding promises and IOUs to those holding real, tangible assets with finite supply and infinite demand. In this moment, every ounce of silver acts as a lifeboat in a sea of burning fiat. It is the transfer of purchasing power from the masses who trusted the system to the few who understood its fragility. This is not a market correction. It is the fundamental revaluation of what constitutes real wealth. So we look back at the pattern, the four-stage machine that has been set in motion. Stage 1, awareness, as the few began to see the structural deficit. Stage 2, accumulation, as smart money and industry quietly built their positions. Stage 3, the shortage, where the physical disconnect from the paper price became undeniable.
A heavy check mark now sits beside stage 3. It is complete. An arrow now points with the cold certainty of mathematics to where we are now. Stage 4. The panic. This isn't an opinion. This isn't a prediction based on sentiment. It is the logical outcome of a simple equation. Record-breaking industrial demand crashing into dwindling, finite supply. The inputs are known, the process is clear. The machine is the same, the outcome is the same, and the only question left is you.